Hello and welcome to today's free trading video and market analysis. I'm your host, Kenny, Senior Research Analyst with the MiniAnalyst.com. On this Wednesday, December 17th, about a week before Christmas, holiday shopping season in full swing. First thing we're looking at here is a chart of the market. This is the mini S&P 500 futures contract. Trying to get above yesterday's high. We did have the reaction from the Fed, lowering the Fed funds rate target to about 0%. Very impressive move by the Fed, and the market liked it as well. We did have a little bit of choppy action, the 1, 2, 3 pull up, and then we just blasted to the upside. We'll look at actually, we're seeing our intraday dynamics, our proprietary indicators, suggesting that the move was going to be to the upside, but as usual, you do have the drift higher into the market, so that's up for debate. Nevertheless, the market did like it. We got to close at a new short-term, intermediate term. We'll call it a high from an intraday perspective, and not really following through today. We generally like to make our biases the following the post early session of a Fed day, which would be right around in here. Not really following through, so the jury is out, although the market is remaining higher. We are above the trend. We do need to blast above 915 in the E-mini S&P. Are we going to do that? Well, we're having some negative divergences here. If we go back, this is Wednesday, Tuesday, Monday. And if we go back, we can see that we did get the nice move, acceleration move lower once we broke below the trend. Bearishness was accelerating. Boom, you get the nice move, followed by the following day. We did get some divergences here, suggested that this move was not going to happen or was not going to stay. Chopped around, broke above the trend, but it's just a really choppy day. Closed at the highest session, but price action just really wasn't impressive. Suggested that once we saw this extreme bearishness, accelerating bearishness here, bearish, that we would get a close or a move lower. We did ultimately get a move lower with a short covering rally ahead of the Fed, as to be expected given the usual drift higher aforementioned, and we did see a divergence here to the bullish side, bullish, and accelerating bullishness here, suggesting you buy here at around 885 in the market, we'll call it. So there's a nice 30-point move from a discretionary bias yesterday, particularly as we just came down ever so slightly, glanced the trend, but we don't need to spend too much time on this. That's where we are on the market. This is an intraday perspective. We did get the negative momentum divergences here. Negative proprietary indicator divergences here. So until we get above 915, don't really expect too much from the market where we aren't. If we go over and look at, there's our Russell Day Trader 1.0, probably our oldest system in the book, banking a huge $2,000 per contract. Actually, this is the second oldest day trading system we have. This trades the E-mini mid-cap. The Day Trader 7.0 was a former S&P Day Trader 1.0, rolled out of rotation. We put it back in as the Day Trader 7.0, and still continues to really make us glad that we did do that. Very impressive move was the gain yesterday, just ahead of the Fed. Went long just ahead of the Fed and blasted, took advantage of the entire move of that. And we're trying to take a look at, there we go, our daily. Here's a chart of the daily market, the cash market. We have been bullish, as mentioned. Went bearish from an official market timing perspective around 1375 or so. Went ahead and covered that in an unusual move. Just take advantage of the acceleration move to the downside that we saw. Mean reversion, if anything. And that's essentially what we've had, at least a basing, hopefully a bottom, because we do remain officially bullish from a market timing perspective, although from a trend following perspective, and generally we would certainly be bearish and selling at around 930. So we'll wait and see how the market goes, see what the internals do, see how we're going to play the move to the to this blue line right here. Should be around 930, 931 we'll call it. So once we get above there, but a quick move to 1,000 in the S&P, and this ascending wedge right here, ascending triangle, suggests that we should, that we should get that move. And this was the bottom, the actual bottom, the 2-bar reversal buy setup that we did mention coming on this day. And we'll go ahead and just take that off of there. And of course, the bottom was on November 20th. The low was 747.78. We're at 900, 150 point move. Very nice move we have seen off of that. And as mentioned, this textbook positive momentum divergence. Just a very great indication of the market. Market making a new low, momentum not making a new low, suggesting that we are going to get a snapback higher, probably to around 1100 in relatively short order by January, should this move continue to hold. Everything else bullish, intermediate term, neutral. This should read, but we'll give it bullish given the work that it's put in. Having said that, let's see if there's anything else we wanted to look at. There's the Russell Day Trader 1.0 that we mentioned. Again, just capitalizing. This was actually last Thursday, I guess. Buying right there at around 445 to 450, covering at 470, almost $3,000 per contract gain. And how does that translate to our portfolios? Well, there you have. There we are buying some stuff. There you have the MAPDT, as this was just on actually yesterday, 12/16. Our MAPDT, this is our original MAPDT, $8,870 was the gain on the $20,000 account. 600% move. It breaks in just 100 days, following the 44% gain on Tuesday. Here were our performances on Tuesday. 44% was the standout for the MAPDT original at a $20,000 account. We'll look at that in a second. We do have those. The return is probably one of this portfolio is one of the highest we have, but of course the risk is the same. One of the higher risky, more aggressive portfolios, we should say, that we do offer. There you have the performances for 100 days. Of the performances, Dual Day Trader leading at 610%, MAPDT at 600%, and Map Black at 300%. Just definitely our favorite portfolio is the Black. Look at the returns, outpacing more aggressive and smaller portfolios. Is the Black at 300%, the $100,000 portfolio. Smaller portfolios there, of course, coming in at 600%. Our two leaders on the 56 days, very similar numbers. A lot of money has been made on these huge moves that we've seen, and we do continue to expect them to occur. On the other hand, we have had some clients mention, is it time to get back into Forex? Our Forex, our MAFX-like portfolio struggled a little bit, just kind of chopped around essentially for a few months. And one of our larger clients wrote in saying, I think it's about time to get into Forex. We were like, well, it could be. And that, of course, is just about a week before it goes on an amazing, stellar run of 300% for the MAFX Lite. Here are the final figures. 9,500 today. It's actually up 12,000 as we're doing this video today. But we'll call it $30,000 in on a $10,000 account in just 5 days. There you have it. Very impressive. And we also have our returns out. Updated returns for the fiscal quarter ending November 30th. Here are the performances, and if you want to subscribe to any of these portfolios, you can just click there, kind of a little quick link column. And if you want more detail, you can go to our scroll a little bit lower, look at the Map Black version 2.0. There's a new version with only a 28% drawdown, 715% return, average drawdown of only 6.33%. This, of course, is using $26 per round turn for slippage and commissions. The Delta Black $80,000 portfolio, very impressive 600% return, average drawdown of 7%. 51% was the maximum drawdown. Of course, a lot of our maximum drawdowns have been increased due to the recent volatility that we've seen. But as you can see, by month's end, the performance figures are astounding, with October being just a simply banner month. November for the Swinger DT 2.0 was the banner month at 8% average drawdown. The Delta C, great portfolio. Map DT version 3.0 is the main Map DT we're looking at right now, is the 3.0, and then Map DTS version 2.0, average drawdown of just 12.6%. against return of 775%, nearly 800%. So the Map DTS version 2.0, very impressive. And finally, we do have the a new $50,000 Map DT version 4.0 for a $50,000 account, 800%, and Map DT high risk at 25,000 with a 1,500% return. Of course, you're having a lot more risk there. If you guys have any questions, go to the website, chat with the support team, shoot us an email to admin@MiniAnalyst.com, and we hope you are having a great trading week. We'll see you next time.